If you're interviewing for a job in investment, chances are you will be asked how you would invest 1 million or 10 million today. And this is an asset allocation question. So to get extra points, you should be talking also about the business cycle and how it affects investment choices. Doing this will show that you're aware of the major economic indicators and also that you can think about investment from a macroeconomic perspective. So let's start with some definitions. The business cycle shows us the fluctuations of real GDP over time. GDP stands for gross domestic product and is the total amount produced and consumed within an economy. With the business cycle, we see how real GDP evolves over time and how it compares to the overall growth trend, where the trend is the straight upward line, while the cycle is the succession of these peaks and troughs. That's because growth in real life is never a linear process. It has, like most phenomena, its ups and downs. The major stages are expansion, peak, recession, trough, and recovery. Where we are in the business cycle matters for investment decisions because asset classes behave very differently throughout these phases. Big institutional investors always have conversations on how to interpret economic indicators and how to best react and position their investment portfolios. That's why you should also know about this stuff. So now let's briefly talk to the stages and then we'll see how people position themselves throughout the business cycle. Let's start with expansion. As the name suggests, this phase is an uptick in most economic indicators such as demand, profits, wages, and output, and other factors that contribute to growth. During the economic expansion, investment is high and profits are high as well. Loans are repaid on time and economic conditions are favorable for new startups to develop and gain their footing despite the competitive market. With all this expansion, inevitably follows the peak. At this point, we've reached saturation, so there's no room for further growth and prices are at their highest. This also means that appetite from consumers starts to fade away. This excess supply of goods and services is followed by a decrease in price, which leads to lower margins, redundancies, lower output, etc. in a vicious cycle that feeds itself. And this is proper recession. Recession is technically classified as 2 straight quarters of real GDP contraction. Bottom of this phase is called trough. This is the worst point from a recessionary environment. Both demand and supply reach an all-time low and there is depletion of income and expenditure. Finally, we have the recovery stage where the economy moves towards regaining its lost footing from a negative growth rate. Demand starts to pick up again with supply slowly catching up. Consumer sentiment improves and people redevelop a positive attitude towards investing. This virtuous cycle starts to generate new opportunities for employment as well. So let's see how this feeds into investment decisions. During the expansion stage, best performing asset classes are equities and credit, so high yield and investment grade corporate bonds, but also venture capital and private equity. So if you're going for an interview and the economy is in expansion, you should definitely recommend an overweight to risk assets given that the outlook is positive. Within equities, preference should go for growth stocks and for sensitive sectors. Sensitive sectors are those with a beta close to 1, so technology, communication services, and energy. In your portfolio allocation, you want your beta to be close to that of the market because you want to be riding this positive trend. In the initial phase of recession, instead, it's better to be positioned defensively. Anticipating stimulus from central banks, which drives rates lower and bond prices higher, is a good idea to have exposure to government bonds. Within equities, it's best to overweight defensive sectors and quality stocks. Defensive sectors are those with a beta lower than 1, so consumer staples, utilities, and essential healthcare. These are the least cyclical stocks in the economy, so we can expect them to hold their ground and keep generating profits given their essential nature. Finally, in the recovery phase, as the economy bounces back, you want to be exposed to cyclicals and you should be aiming for a beta higher than 1 so that your rebound can be faster than the competition. So you'll be overweight sectors such as financials, materials, real estate, and consumer cyclicals. The duration of the business cycle can be variable. Sometimes there are external shocks to the economy that influence its timing. In March 2020, for example, we saw economies shutting down because of the pandemic, nobody knew what to do, and stock markets collapsed everywhere. At that time, we experienced a sudden recession to which economic stimulus followed, both from governments and central banks. Today, we are in the phase of expansion, with some arguing we're very close to peak. Unfortunately, there's no way of telling when exactly that might happen, so the wisest thing to do is to keep a balanced asset allocation, aiming for a beta of 1 to keep riding the trend. If you're still watching this, congratulations and thank you so much. I hope that you learned something useful today and I'll catch you very soon.